Imagine you are paying premium to two different insurers for the very same item, thinking that you've bought yourself an extra protection. It feels like a safety net, right? However, in the short-term insurance sector, double insurance does not mean double payout. Instead, all insurers covering the same item or risk will share the cost of the loss between themselves at the claim stage. And that is the principle of dual insurance. I am Ryan from Rebote Risk Management, and in this video, we'll cover what dual insurance actually is, how it works when you make a claim, the common ways it happens in practice, how insurers detect it, and most importantly, how you can avoid it. So, by the end of this video, you will know exactly what dual insurance means, why it happens, and how you can protect yourself from unnecessary costs. So let's start by unpacking the basics. What exactly is dual insurance? Dual insurance happens when the same item, asset, or risk is insured by more than one insurer at the same time for the same type of loss. At first, it might sound like a smart way to get extra protection, but that's not how it works in practice. Let's say you insure your car with two separate insurers, each under a full motor policy. If that car is written off, you can't claim the full value from both insurers, even though you have paid two premiums. The loss itself is a single event with one value. The key principle here is that you can only ever be restored to the same position you were in before the loss and never placed in a better one. So, if you can't claim twice, how does dual insurance actually work when you submit a claim? Let's break that down. With dual insurance, the claim isn't paid in full by each insurer. Instead, it's shared. This is done through what's called the principle of contribution. It means the insurers split the claim between themselves, with each covering a portion of the loss that matches the cover they provide. For example, if you insured the same vehicle with two insurers and it's written off, you can't collect two full payouts. Instead, each insurer contributes towards that single loss, ensuring that you are indemnified, meaning you are restored to the same financial position you were in before the incident, but never placed in a better one. This often leads to another common question. If insurers only contribute a share of the claim, should I also get a refund on my premiums? In South Africa, the answer is generally no. Premiums are charged for carrying the full risk during the policy period, not just a share of it. Both insurers were on risk for the entire period, so they earned their premium you paid. Refund may only apply in very special circumstances, such as when one policy is cancelled earlier or when a second policy was taken out by mistake with no claim submitted. But in most cases, dual insurance does not mean you will get any premium back. Now, let's look at the common ways in which dual insurance occurs. Dual insurance can happen more often than you think, and sometimes in ways you don't even realize. Let's walk you through a few examples. It often starts with something as simple as your home loan. Most banks automatically include property insurance as part of their bond package, but if you take out your own property insurance policy directly, suddenly the same house is covered twice for the same risk. That's one of the most common ways dual insurance shows up. Another situation comes up in business, particularly the supply chain sector, where, especially when it comes to goods in transit, imagine you run a business that sends out goods. So you insure the stock because if it's damaged, you will financially feel the hit. At the same time, the logistic company transporting it may also insure it, since they are contractually liable while it's on the road. Both parties have legitimate insurable interests, but together they are unknowingly creating what is called dual insurance. It can also happen with the same policy structure itself. Let's say your building is insured under the fire section of a policy, but the same building is also listed under the property section, which provides comprehensive cover that includes fire. If a fire breaks out, both sections could respond to the same loss. That overlap leads to dual insurance unless it's managed carefully. And then there are cases where dual insurance is done intentionally. For example, you might cover all your office contents under the general contents section, but content sections cover usually places limits when it comes to electronic equipment such as printers, TV, servers, and the likes. So to close that gap, you might also take out an electronic equipment policy. Now, those same items are insured twice, once under the content section and again under the electronic equipment section. If a common peril like theft occur, contribution will apply if both insurers are approached for the claim, unless insured with one insurer. So whether it happened by accident, like with a home loan and the goods in transit, or deliberately like with a restricted cover on electronic equipment, the outcome is always the same. Contributions apply and insurers share the claim rather than paying it twice. So now that we have seen how dual insurance can occur in practice, let's look at exceptions, cases where the rule might play out a little bit different. Now, while most cases of dual insurance result in contribution, there are some exceptions, situations where the rule might play out a little bit different. One example comes from sectional title schemes. By law, the body corporate must insure the entire building for its full replacement value. But as an individual owner, you can also insure your own unit, especially for things that the body corporate's insurance policy might not fully cover. For instance, you may have upgraded your unit with new features or customized fittings, or you might want cover for renovations beyond the standard structure internally. In this case, both the body corporate's policy and your policy could respond to the same loss. Some insurers may choose to apply contribution here, while others might reject your claim if they believe that the body corporate's insurance policy should be the one that applies in full. Either way, one thing remains certain, that you will never be paid twice for the same loss. This exception shows that while the principle of contribution is in rule, there are areas where its application can vary depending on policy wording, the law, and how insurers interpret responsibility for cover. So that's what happened in the exception, but it raises another question. How do insurers actually detect when dual insurance exists? When you submit a claim, insurers use different methods to verify the details depending on the type and the size of the loss. In some cases, this can extend to a full investigation if the insurer feels it is necessary. One of the most important tools they rely on is policy disclosures. From the very beginning, when you complete a proposal form, and again, when you fill up a claims form during or after the loss, you are asked whether the item is insured elsewhere. This isn't just a tick box, but it's a legal declaration. If it's answered dishonestly, it can directly affect the outcome of your claim. So to support this, insurers also run checks in the background. They may use ITC reports, motor registration records, property database, and shared claims history systems, which often flag when the asset or the item is insured with more than one company. On top of that, many insurers have internal systems that automatically highlight any overlap. All of this makes dual insurance very difficult to hide, and it drives home one critical point: transparency matters. Not just when you claim, but from the very start of the policy. So if insurers can detect dual insurance so effectively, how do you then make sure you avoid it at the first place? The truth is, having two policies covering the same item rarely benefits you. In fact, it often complicates the claims process and can even put you at risk of rejection if insurers dispute the liability. So, how do you avoid it? It starts with awareness. Before you take out new cover, always review the policies you already have. If you are working with a broker, disclose every policy in place so that they can be able to pick up any overlap on your behalf. Another simple step is that you ensure that you cancel all the old or the duplicate policies when you're switching insurers. Yep, I know. It's easy to assume that old cover falls away automatically, but unless you cancel it in writing, you may still be paying for two policies unnecessarily so. Dual insurance can also creep in when you intentionally try to fill in the gaps. For example, you might keep contents cover in place while you're adding a specialized policy for your electronic equipment. That's not always a bad thing, but if you do it, make sure that your broker or your insurer knows about both policies upfront. It's also worth checking agreements that may already include insurance, like your home loans, levies, or service contracts. Many people double up simply because they didn't realize the cover was already built in. And finally, if you suspect you are already having a dual cover, don't ignore it. Bring it up with your insurance broker immediately. They can confirm if contribution would apply or advise whether one of the policies should be cancelled. Because here's the key takeaway. Dual insurance will never give you a double payout. At best, insurers share the claim. At worst, it creates disputes and delays. Either way, the best practice is always full disclosure and keeping your cover clean and simple. Remember, this video was only made for sharing educational and general information purposes and does not constitute any recommendation or a formal financial advice. For a personalized guidance on your specialized or specific risk please consult a licensed broker. Thank you for watching. Never forget to subscribe and hit the like button.